Good morning, LabCoatAgents. Vanessa Noble here from Anchorage, Alaska with active duty passive income. And of course, my favorite co-host to interview, Patrick Kappel out of San Diego. Good morning. Good morning.
Hey, Vanessa, how's it going?
Good. I went solo without you last week. And how was your vacation? How was your camping trip?
It was good. I mean, the entire West Coast is nothing but smoke. So I went to the Midwest for about a week and I got out of the smoke. And as I flew back, I could see, as soon as I got to Denver, the clouds were nothing but smoke. Denver to the Pacific Ocean.
So you were actually able to enjoy some clear.
Yeah, I was in the clear skies for a bit. It's sad how much the West Coast is burning right now.
Like, it's not even the West Coast anymore. It's like the entire half of the country.
Yeah. Yep.
Yeah.
But no, I'm back in San Diego and definitely ready to talk real estate today.
Awesome. Well, it's a perfect segue because last week I talked about owner-occupied, low capital entry level starting, where people may not have the capital to go straight into syndication. Well, obviously you don't need capital for syndication, but into commercial investing or second home investing. They don't have the 20% down. So what is the pathway for entry level, owner-occupied, low down payment options, how to stack them, how to create a strategy in advance to buy multiple properties on low capital when they don't have income that they can supplement or change, quickly to be able to afford 2, 3, 4, 5 homes. And so the perfect segue is whenever we, sometimes obviously you end up with a high appreciation opportunity that you can cash out on, like a 4-year in like growth in a market, right? Sometimes we'll have these crazy 4-year inflations. Like we saw this in Colorado Springs recently had a crazy appreciation window, and people were able to scoop out larger sums in a short amount of time. But normally you're going to see this once you have seasoned a property over 7 to 10 years, you're going to have your natural pay down of your equity position and your natural ebb and flow of the real estate cycle that will create appreciation for you, depending on what market you're in, of course. But being able to, regardless of which circumstance you find yourself in, whether you're in the, kind of get rich quick opportunity or the long, normal, wealth building strategy of real estate, really knowing what to do with your assets. And I just went over this with a service member, and that will have 2, 3 properties that they've collected because the military has moved them. And now they're like, okay, I have like 150 here, 200 there in value in these homes. What do I do with it? And really quick, the principle is scoop out and reinvest. So why don't you talk to us? Because the whole idea of, pay down your mortgage and sit in your rocking chair on a porch, like that's Depression era thinking. When you really look at leveraging and reinvesting, that is, the approach that the wealthy take advantage of. So why don't you share from a tax perspective, what's the game plan?
Yeah, absolutely. And I like that you last week kind of covered first-time home buyers. How do you start out? You don't have a lot of money, because that was me 12 years ago. 12 years ago, I was a young guy in the military, didn't have a lot of money. I had maybe $15,000 saved up, and I used a low down payment loan to buy a $127,000 condo. Yeah, $127K, that's a condo out here. And now fast forward 12 years, that property's worth $260K. So there, I over doubled my value of the property, but I only had put down like 3.5%. So I only put down
that property.
Yeah, I've held it. I still have it. Yeah.
And so you didn't use your VA loan. You used a FHA product.
FHA on that one, and I mean, I put down what then about $5,000-$6,000. And it's grown by, over $100,000, $150,000 in the last 12 years. So for a $6,000 investment that I put into it, $160,000 return, in about 12 years is not
Like,
bad.
that's ridiculous. Yeah.
Yeah, but that's just the name of that's real estate. Like that's real estate. That's how you know, I just put a post up stating that 90% of millionaires made their millions through real estate. And as you mentioned, the rich, the wealthy, they utilize money in a different way than Depression era thinking type of folks. The rich and the wealthy are not afraid of debt. They are afraid of consumer debt, but they're not afraid of things like real estate debt. And we'll talk about today how you can take on more debt, and taking on more debt can make you more money as long as you do it wisely.
And that's why I always tell people is creating the strategy is like so important, and beginning with the end in mind. And, you know, one of the things I'm going to get patriotic on you is that, like, and, you know, as both of us being fellow service members, people don't realize the opportunity that they have in this country to even invest in real estate. Like, I still, and I haven't done a ton of research, but I mean, I'm still looking for a comparable country that has a credit system to vouch for you, that has a financial system to lend you money, and that has the land that they allow you to purchase unto yourself to go ahead and create this, leverage the loan to create wealth for yourself in our country. You know, I mean, I'm still trying to figure out which other country gives people the opportunity to invest. And that's why, you know, no other financial vehicle has created more wealth for human beings than U.S. real estate. Because if you don't think foreign investors are here, you know, they're buying those mortgages, and they're investing in our soil and our land, because the value of the United States is so high and so stable, and has historically been. I won't speak to the future with what's going on in the world today, but the opportunity for us to just even buy a house and create this investment path is and all the tax stuff, the tax laws, like, that's American. Absolutely. Right? Those opportunities are not anywhere else.
Yeah, you know, and I see on the LabCoats Facebook page a lot of times agents asking, how do I convince a buyer that doesn't want to buy? How do I convince a buyer that is afraid there's going to be a crash? Or convince. I usually just talk about deal stories and reality and what I've done. And like, again, I always use the house I'm sitting in as an example. I bought this house with 0% down because, as you mentioned, the VA home loan, right? 0% down. And now it's worth $500,000 more than what I bought it for. So if you go to a buyer and you say, hey, how would you like to make $500,000 doing nothing? Most buyers will say yes. And then you tell them how to do it. So instead of going to a buyer and saying, hey, why don't you buy a house? I go to a buyer and say, hey, would you like to make $500,000 doing nothing? And they'll say yes. And then I'll say, here's how you do it. You buy a house. And
you know, it's funny because people get so scared of being a landlord. And like somebody was telling me the other day, like, you know, what about being a landlord or whatever? And even just my fourplex as an example, I'm like, I took 2 phone calls last month, and I'm going to make $24,000 on that one property. Like in a year, and that's just cash flow. That's not equity position. That's not tax incentive. And I'm like, would you take 2 phone calls a month for $24,000? I don't know. Right. Like it's people, you know, and it's been great when, especially talking to service members, the first time you jump, like the airborne guys jump out of a plane, it's scary. The first time you buy a house, it might seem scary. The 10th time you jump out of a plane, not scary anymore, you know? And so it's just, when you're around people, it's the people that you're around. When you're around people that are just doing it, you know, and just buying homes and acquiring assets, it's not scary anymore. And so it's just helping people get over those mental barriers is what they really are.
Absolutely. And you know that a lot of agents, again, out there, they have buyers on the fence. What I would recommend doing is take a lot of the information that Vanessa and I cover during these and do webinars, do seminars to teach all your buyers.
Regurgitate it.
Once a month, I do a real estate San Diego market update in its webinar format. And my team is working with dozens and dozens of buyers on any given day. And we invite all those buyers to log into the webinar on Thursday night. And they log in and they get convinced that buying is a normal, insane thing to do. And it just makes sense. And I cover a lot of the stuff I cover during this and just market update info. So with that, why don't we jump into where I promised 2 weeks ago when I was last on here. We covered cash flow versus appreciation, cap rate, GRM, how do we look at the MLS? And today I promised that we would do a deeper dive into what do you do with your money if you did invest for appreciation. So we're going to look at the cash out refi, and we're going to do a deep dive into the 1031 exchange. So if you're an agent, you've probably heard of 1031 exchanges. What is this thing called the 1031 exchange? How is it used? And more importantly, how do you explain a 1031 exchange to your client, especially if your client is an investor? So I'll do a shared screen here. I'm sure you can all see it now. And we're going to pick up where we left off last time, talking a little bit about why would you even want to invest for appreciation versus cash flow. And I narrowed it down to one primary reason. And that is when you invest for appreciation, your gains are not taxed. When you invest for cash flow, your cash flow is taxed at the highest income tax level in America, and that's ordinary income tax rates. So if you are investing for cash flow, all that cash flow is getting taxed at these rates. 2020 tax brackets, ordinary income. It's not a capital gain, it's ordinary income. If you're married filing jointly, you see your tax rates going down here. Most of you that are making decent money and you've got a portfolio of investments, you're going to be getting nailed with about a 24% plus or minus tax rate, plus you're paying all of your state taxes on it. Now, for those that are investing for appreciation, first of all that appreciation is not taxed. Uncle Sam does not tax gains in real estate until you actually sell that real estate and realize the gains. You have actual gains and then you have realized. A realized gain is one that, hey, you've sold it, the money's in your pocket, now you got to pay taxes. When you sell real estate that has appreciated and you realize those gains, they're recognized by the IRS, you're going to get taxed at these tax rates, 0, 15, 20%. And again, you see married filing jointly. Whenever I talk with my clients and I say, hey, Mr. Buyer, let's invest for appreciation, because if your property goes up 50,000, 100,000, 200,000, this is your tax rate. Your first $80,000 of a gain on a property is not even taxed. Then everything up to nearly $500,000 is taxed at only 15%. And rarely is someone going to have a real estate gain more than $500,000. But if they do, that's capped out at only a 20% tax rate. Whereas if we look backwards again here on this previous slide, your cash flows are getting taxed in the 20 percentile tax rate already at $80,000. This is why I don't invest for cash flow, because I don't want to give a quarter to a third of my profits to the government. I want to keep 100% of my profits. And if I ever do just cash out and take the money, I want to minimize how much I have to give to Uncle Sam. Because trust me, if you are a real estate investor and you think you're investing by yourself, or you think you're investing with one or two other friends, there is a silent partner on all of your real estate investments. And that silent partner is the government. The government makes some decisions for you because they have rules and regulations you must follow. The government also takes a healthy chunk of your profits. And if you want that silent partner called the government to take a smaller bite out of your profit, then you invest for appreciation. If you want that silent partner, the government, taking a big bite out of your profits, then you invest for cash flow. And it all comes down to how they're taxed differently. Now, for appreciation, I mentioned that all those gains are tax-free. You can own a property for a decade and not pay any taxes on the appreciation. But once you sell it, if you take the money and put it in your pocket, you're now getting taxed on those gains at these tax rates that you see in front of you on the screen. However, I still like to draw that analogy. At least you weren't taxed as high as you would have on this upper range here if you were getting it as cash flow. All that said, I think I showed you this one last time. Ben Franklin, he said 2 things are certain in life, and those 2 things were death and taxes. And I love Ben Franklin, but he was not alive in our era. And there's something that he never experienced. Ben Franklin never experienced the 2019 tax code that was recently passed. And with this tax code, and you know what, even before this tax code, you can avoid taxes altogether if you invest for appreciation. If you invest for cash flow, can't avoid taxes. There's some ways to mitigate taxes and minimize them, but you can't avoid them. With appreciation, all that appreciation, you can definitely avoid taxes through the 2 bottom things that you see on my bullet points here. First of all, we already talked about, hey, if you just take the money and run, you're going to get taxed as a long-term capital gain. Not bad. But the 2 ways to avoid paying taxes altogether are the cash out refi and the 1031 exchange. We nickname it swap till you drop, and I'll show you why in a minute. What we're about to do is a real quick look at a cash out refi. How does a cash out refi work? Then we'll take a deep dive into the 1031 exchange, because I think the 1031 exchange is probably not understood as well as a cash out refi. So we'll spend some more time on that. Now, a cash out refi, real layman's terms here. This is a great slide to share with your clients. It simply shows how do you get money out of that property without paying taxes on the money that you've gained. So in this example, let's say you bought a property, a house, maybe it's a rental home, single family rental home, or maybe it's a fourplex for $400,000. So I bought this a long time ago, $400,000. My loan now is $300,000. And because I bought it a long time ago for $400,000, this property is now worth $500,000. Well, if I got a property worth $500,000 and I've got an existing loan of $300,000, how much equity do I have in the property? Easy math, $200,000. Okay. Now, most lenders aren't going to let me take out all $200,000 unless it's an owner-occupied loan. Then I could probably take out darn near all $200,000, especially with the VA type of loan. But if it's an investment property, which it is in this example, a lender will usually let you pull out up to 75% of the property's value, so that you still have 25% or 20% equity in the property.
And really quick, before you move forward, one thing that I would like for you to come back to is what you mentioned there, that when people can own or occupy and still cash out refi to refinance. So a lot of times when we're talking about these entry, investment strategies, people are like, oh, I don't want to move. Well, you don't have to if you choose the owner occupied path. I mean, I know that's not your example now, but you did that several times, Patrick, with the home that you currently live in. You've never moved, you've just scooped it out, reinvested. And so I think that's important for people to be mindful of as well.
Yeah. So, in fact, I'll give you that case study. I'll give you that case study on what I just did and how I bought something with 0% down a couple of months ago. Real quick on this example, just to finish up the example here in front of us. When you have this home that's now worth $500K and you have a $300,000 mortgage, you simply get a new loan for $400,000. So in this example, it's an 80% loan to value. You're going to have 20% equity in the property still. That $400,000 loan pays off the old $300,000 loan, and you now get $100,000 cash in your pocket. How does that work? Well, what's 400,000 minus 300,000? 100,000. That cash goes in your pocket, and you can do whatever you want with that cash. And Uncle Sam does not tax you on it. So you just made $100,000 tax free. Now, if you use this money to go buy like a boat or a fancy vacation, the interest associated with that $100,000 portion, you can't deduct on your tax return. And that's kind of an in-depth tax question. By this point, if you're doing these types of things, you should be working with a good CPA. But just really, to be blunt, the interest associated with that 100K, you cannot deduct the interest associated with that 100K if you go and spend this on some consumer good. But the interest associated with the original 300K, you can still deduct that interest because it was used to buy this house. So in other words, 25% of this $400,000, you can't deduct the interest unless you do what I would do and what I recommend doing. You use this $100,000 cash out to go buy some more real estate. Why would you do that? Well, first of all, your mortgage payment's going to go up a little bit because you just took out a bigger loan. So if your mortgage payment's going to go up a little bit, use this cash you got out to go buy another asset that's going to pay you some money, pay you a little bit of rent, pay you some more appreciation. So I would use this to go buy more real estate. Now, if you use that $100,000 to go buy more real estate or any other type of investment, you can now continue to write off the interest payment associated with this $100,000 portion. So as Vanessa mentioned, just a couple of months ago in July, I did just this. I've got this house in San Diego. I bought it years and years and years ago for $700K. I bought it with a VA loan for $700,000. So I put down pretty darn near zero, had some closing costs and whatnot, but pretty much zero. And now it's worth well over $1 million. So I made all that money and appreciation tax-free. Just earlier this year, I did a cash out refi. I paid off my $700,000 loan. I took out a much larger loan, over $1 million loan. And with the VA loan, I could borrow, I borrowed pretty much up close to the value of the property, to be clear. And I pulled out a little over $350,000 cash. So I got all $350K tax-free. And I used that $350K as a down payment on a $1.35 million fourplex. Now, that's how I bought a fourplex for $1.35 million without any of my own money. I took the money from a cash out refi, which is other people's money. I'm using proceeds off cash out refi. Plus, for the other 75% or so of that loan to buy the fourplex, I took a loan. So my down payment was a loan. The money I borrowed to buy on top of the down payment was a loan. And I bought it absolutely without my own money. So that's where you can get in real estate once you've been doing it for 10 years or so, and you started to build up some equity in the property that you bought 5, 7, 8, 9, 10, 12 years ago, which is why I always say real estate is not a get rich game. Most real estate investors that I see trying to get rich quick, they usually instead end up getting poor slow. You need to be in it for the long game. As Vanessa said, you need to look at 7 to 10 year hold periods. And at that 7 to 10 year point, you pull the cash out. Now, the cash out refi is one way to pull the cash out.
And really quick, what I'll say is sometimes when people are buying a house and they're in the now, when they're in the now, they're like, okay, and people want a quick opportunity. And the thing that I always have to remind people is you don't go sign up for an IRA today and think that you're going to get rich in 3 or 4 years. You don't go and buy any other retirement plan, investment plan, and be like, oh, in 3 or 4 years, I'm gonna have this pile of money. People have this like misconception from watching too much HGTV, you know, with thinking that they're gonna flip and cash. And don't get me wrong, there's those creative opportunities that you can create in real estate. However, the foundational wealth building strategies without playing with a bunch of other risky things is really a 7 to 10 to 20 year play on large, on huge opportunities for wealth. And nobody else looks at any other real estate vehicle with that scrutiny, like people don't expect to get rich in 3 years. So even though when you have somebody buy a house in 7 to 10 years and they look at you like, well, I don't know what my life's going to be like in 7 to 10 years. Well, you're going to hold the property, right? So you just want to plan. And like I just had a seller who had a painful sale in Alaska. The military moved him down to Texas, And because the reason why is I was not their realtor on the front end, they did not buy a wise home. And so they wanted to get out of a low performing asset that really was at an economic ceiling. They weren't gonna it was more of a liability and headache than it was worth keeping. So they moved it, but I told them, now the next time we talk, you're gonna buy asset after asset after asset and create opportunity for yourself and not take this painful loss on a sale, that you're just like, let me just get out of this pain. So, it's just important to keep as realtors that are working day in and day out with residential real estate. And as you're teaching people these strategies, that when you have these conversations and you're like, yeah, this investment's a 7 to 10 year plan, that you're really talking like, yes, buy now, because it's going to take 7 to 10 years to season this asset. So buy 5 of them.
Yeah. Yeah. I mean, I've got clients that are in their 30s and they began investing in their 20s. And because they began in their 20s and they're now in their 30s, they're millionaires. I have some clients in their 30s that are multimillionaires because they began investing in their 20s, and most importantly, because they invested in appreciation markets, not cash flow markets. So all their gains they got to keep. They didn't get whittled away slowly by the tax man. Again, remember, every real estate investment, you have a silent partner, and that silent partner is the government. And they will take 25 to 30% plus of your returns if you don't invest correctly and if you're investing for cash flow. A lot of people invest in real estate because they think, hey, it's all this passive income. It's passive income. And you do. You make a lot of money in real estate. I've probably made more in real estate than I've made just working jobs. But let me be clear. Cash flow, you might think is passive income. And appreciation, you might think is whatever you might think of it. At the end of the day, though, cash flow is not taxed as passive income. Cash flow is taxed as ordinary income.
Ordinary income.
Yeah. Thus, as far as the tax man is concerned, cash flow is not passive income.
And one thing that for everybody is in a different position, like for myself, I am not married. I am a single female, and my cash flowing assets supplement as though I had a second income or I have a second partner. Everybody's tax, but you have to know where you are in your tax bracket. You have to understand your whole tax picture to know whether you're getting the maximum benefit from a cash flowing asset or an appreciation asset, or whether you should not go for a if it doesn't make as much sense. Like, for example, when I would get the PFD in Alaska, and by the time I added $10,000 of my PFD check to my ordinary income, I was like, it's not really worth the benefit, because I was just at this threshold where it kept pushing me over into the next tax bracket. And I was like, nope, I don't want that one, So sometimes like what Patrick is saying, the cash flowing assets, they're not, although they provide you the right now money, they're not as lucrative in the long term. We have 2 questions, Patrick. One is that aren't interest rates for cash out refis higher than regular interest rates? And then, so we'll address that question first.
It depends. Short answer is no. So all the cash out refis I'm doing right now, they're non-owner occupied, and my rates are in the high 3s. For non-owner occupied. And I'm seeing clients buying brand new property, non-owner occupied, and the rates are in the high 3s. So I think all my cash out refis right now are around 3.75, 3.8125, and they're non-owner occupied. But the real answer is it depends. It depends. It depends on how much are you pulling out. Are you pulling out 75% of the property's value? Or are you pulling out 50% of the property's value? What does your credit score look like? What is your debt to income? I guess I see where that question's coming from, because quite often cash out refi, the rate, yes, might be slightly higher. But what I'm doing on my properties is I'm keeping my loan balances around 50% or less of the property's value. So I guess the real answer is it depends on many multiple moving parts with that loan. If you wanted a blanket statement though, yeah, quite oftentimes it could be slightly higher than just a straight up purchase. Would you please share more about your Thursday evening webinar? Yeah, and if Tristan, if LabCoatAgents allows me to, I can post it on the LabCoatAgents Facebook page. A link to the webinar that I'm doing tonight at 5:30 p.m. Pacific time, and then you can kind of get an idea of what I talk about to, you know, all the clients out here in San Diego, to get them on board with realizing real estate's a good investment. So I'll make a note of that to send out to LabCoats my webinar for tonight. Just made that note. But bottom line, guys, is you see down here in the gray, $100,000 cash. My question is for you, would you rather have $70,000 or would you rather have $100,000? And I think most of you would rather have $100,000 over $70,000. If you took the return on this property as cash flow, as a cap rate, a high cap rate market, the Midwest, that type of thing, you would end up with about $65,000 to $70,000 because Uncle Sam's going to take his partnership portion. If you take it though as a cash out refi and you're getting your gains through appreciation, you get to keep all 100,000 and Uncle Sam doesn't take any of it. Now moving on, beyond the cash out refi, let's do a deeper dive. We've got about a half hour left here. So let's do a deeper dive into the 1031 exchange. Maybe some of you have heard of this. Maybe you haven't. If you haven't, definitely pay attention. What is a 1031 exchange? And why is it even called a 1031? It's called a 1031 because lo and behold, it is section 1031 of the United States tax code. So the tax code is a big, thick book of all these regulations and rules that we have in the United States tax system. And section 1031 describes what we're about to talk about, the 1031 exchange. So I've got a real easy depiction here. I think I've shown you before. We're going to spend a couple extra minutes on it today. Let's say I go out, and I'll use me as an example. Let's say I go out and I buy a $500,000 property, a single family home in San Diego, $500K. 10 years go by. It's worth more. Let's say it's worth $800,000, $900,000. I sell that property. I sell it for $800,000, and I walk away with a $300,000 plus equity position in it. What do I do with that money? I use it as a down payment for a property of equal or greater value. Key phrase, equal or greater value. I'm helping one of our friends right now, Vanessa, Brad. I'm helping Brad do a 1031 exchange. We're selling a property of his, a duplex, for $1 million, and we're buying a fourplex for 1.05, slightly more value. Now on this example, we doubled it. We went up to a duplex, $1 million. Let's say another 10 years go by. 10 years go by, this $1 million property is worth a bit more. My tenants have paid down my mortgage for me. Thank you, tenants. And now I sell my duplex and I buy a triplex for 1.5 million, equal or greater value. Another 10 years go by. I sell the triplex. It's gone up in value. Tenants have paid down the mortgage, and I buy a fourplex for $2 million. Another 5 years go by, 10 years, you name it. And that $2 million triplex or fourplex, $2 million fourplex is worth more. I sell it and I buy a $2.5 million fiveplex. Now, as long as every time I sold a property, I used my proceeds to buy something of equal or greater value, Uncle Sam doesn't tax me. Now, if I took my proceeds, hundreds of thousands of dollars on each sale, and I put those in my checking account, Uncle Sam's going to tax me. But if I instead do a 1031 exchange, the money doesn't touch me. I instead have the money go directly into another property. That silent partner, Uncle Sam, he doesn't get a bite out of it. And it's all my money still. Does that make sense? And again, if you have questions, just type them into the chat.
And we have a couple. I'm going to address them right now. Hold on, Patrick.
Sure.
So for the questions here, we have about, would you say that, oh, just kidding. That was in a different place. Hold on. Sorry, guys. I went to the chat instead of the questions.
No worries. No worries.
So So are you saying invest for equity gain? So they kind of tag on each other. There's two questions. Are you saying instead of invest for cash flow versus invest for equity gain, are you saying the rent you're collecting is just covering the mortgage? Sometimes that's kind of a more like longer, it depends question, but it's saying, are you saying that appreciation is the passive income? I'm sure you're gonna like answering that part.
Yeah, appreciation is the passive income. Because again, Uncle Sam taxes active income. Ordinary income is another word for that at a high tax rate. And cash flow is active income. It's ordinary income. Truly passive income is, or passive net worth growth is income like this. Appreciation. Your net worth is going up. You're not realizing that income until you actually sell a property and do a 1031 or you do the cash out refi. And this is not taxed at all. Zero tax. And people said, do you sometimes buy stuff that just breaks even? The rents just cover the mortgage. Of course, almost everything I buy just breaks even. In fact, a lot of stuff I buy, I negative cash flow, and I'm okay with that. The fourplex I just bought, I'm negative cash flowing about $1,000 a month. I wouldn't do that when I was a brand new investor, but I can handle it now. Why would I buy something?
That's key. That's key, right? Like these advanced strategies, when we talk about negative cash flow and all that stuff, they're advanced strategies. You don't start talking to, like in my case, an E3 and telling him he's going to be upside down $1,000 a month but like that's not the conversation for that person. There's another strategy for them. But I do talk about these concepts in a long term. Like, hey, once you have 4 properties under your belt and you have more cash flow than you really should be living on, look at appreciation opportunities with non-owner occupied, because for people that are living in areas, maybe like you live in San Diego, not everybody lives in San Diego, so they're not going to take owner occupied opportunity. But a lot of the real estate that you buy is not even owner occupied. I mean, almost all of it, virtually, you live in the home that you live in. So, you're investing in San Diego, and anyone can invest in San Diego. Also, people have this limitation that they think, well, like, why would I invest in a market that I don't live near?
Yeah.
Bad mindset.
Well, and let me further explain my example. And my example is extreme. I definitely agree. Why would I buy something that negative cash flow is $1,000 a month? Before you all think I'm an idiot, let me tell you why I would buy something that negative cash flows $1,000 a month. Because it's actually making me about $6,000 richer every month. How does it do that? So my mortgage payment is big, right? It's that fourplex I bought for $1.35 million. I'm getting really good rents off of it, and the rents will go up through time because it's a little bit below market rent when I bought it. But with that negative cash flow of $1,000 a month, think about this. My mortgage payment, $2,000 a month of that mortgage payment consists of principal. Principal is the tenants paying my mortgage, and that principal is my loan going down, so my equity going up by $2,000 a month. So even if the property didn't appreciate, if I'm negative cash flow $1,000, but my principal is getting paid down $2,000, then my net worth is going up by $1,000 every single month. Additionally, a $1.35 million property near the beach, as this one is in San Diego, it's going to appreciate it at 4.5%, 5%, if not 6% year over year over year, which tells me it's going to appreciate at about $60,000 a year. An appreciation of $60,000 a year is $5,000 a month. So that fourplex I bought is, believe it or not, appreciating at about $5,000 a month. So if I'm negative cash flow $1,000, but my principal pay down is $2,000, so I'm already right side up by $1,000 a month, plus it's appreciating $5,000 a month, my net worth is going up by $6,000 a month by doing nothing, by just holding on to this. And that $6,000 a month of net worth gain is not being taxed. So I would rather make that money in a tax-free way than being taxed. And that's why I'm okay with a little bit of negative cash flow. And hey, if I'm negative cash flowing, my net worth might be going up 6K, but I can now use that negative cash flow to write off ordinary income. I also want to highlight what happens up here. at the top of the bar, because I say step up cost basis, tax free. What's going on? What's going on with all that? And Vanessa, I think we're getting feedback. I don't know if you're able to mute, but we're getting a bit of crazy feedback here. So let's say I did all these 1031s and I'm up to 2.5 million. I've got this 5-plex. This is very important. If I sell this property the day before I die, if I sell it while I'm alive, I'm going to pay capital gains on all the gains I experienced from 500K up to 2.5. So I'll pay long-term capital gains tax on over $2 million. At least that's long-term capital gains though, and it's not ordinary income tax rates. However, the IRS allows something very, very special to happen. Let's say instead of selling this property while I'm alive, I die at the age of 95 and I leave this property to my daughter, Sophia. And Sophia inherits this 5-plex at 2.5 million. Now remember, if I sold it while I'm alive, I'm getting taxed on all these gains. But if my daughter inherits this property, the IRS does something called a step-up cost basis. And cost basis is just a fancy word for how much did you pay for it? What did the property cost you when you got it? And my cost basis goes all the way back here to the beginning, 500K. If I leave this to somebody in my will, it doesn't have to be my daughter, it could be a sister, it could be a friend, it could be anyone. If I leave this to someone in my will, they get the benefit of a step-up cost basis, and the IRS pretends that my daughter bought this for 2.5 million. They give her a step up in the basis of the property. So now my daughter can sell it for $2.5 million and not pay a penny in taxes. This is how you build real generational wealth in a family, is you buy assets that appreciate. You pass them on to your children, to your heirs, and then they can sell them and enjoy that $2.5 million sale and not pay a single penny in taxes. Now you might think, well, Patrick, that's cool. I love my kids, but I want to enjoy some of that 2.5 million as well. And when I turn 60 or 70, I kind of want that cash flow. I don't want it all just sitting in a high appreciation market. Easy day. So this is the answer to that question. And this is what I'm going to do. When I get around 60 and I'm thinking, hey, it's time to sail away in the sunset and just cruise on a yacht, I will take my properties that are at these higher values, all these gains tax-free, and I'm going to roll them into something called a DST. What's a DST? A DST is short for Delaware Statutory Trust. The best way to explain it is, let's say we have a $100 million building. Who can afford a $100 million building? Very, very few people. But who can afford $1 million building? A lot of real estate investors can. So what a DST does in this $100 million building example is it will get 100 investors. And they'll say, hey, give us $1 million. All 100 investors give us $1 million, and we're going to go buy this $1 million building. Now that's a very simple example. A lot of times you'll use loans and other things to use leverage, but for an easy example, $100 million building, 100 investors, and all 100 investors give $1 million. So in this case, what would I do? Well, probably at the 4-plex point. Let's say I got this 4-plex and I'm 65. I would sell the 4-plex and roll this $2 million into that Delaware Statutory Trust. I'd roll this $2 million into that DST. Now I own 2% of a $100 million building. And what a DST is going to do, I don't have to manage it. I don't have to worry about it. There's a manager, and they'll send me a 6% check in the mail every quarter. So every year I'm making a 6% return, which is a decent cap rate, right? It's not like 7 or 8%, but I'm getting a 6% return on that $2 million, plus all the appreciation of that building. When it's sold off in 10 years, I'll get that return as well. So now I am just sitting back, drinking Mai Tais on a boat, collecting those 6% checks in the mail off of the investment I made on all this tax-free growth over the last 30 to 40 years. The other way you can get money off of it is just all these cash out refis. And that's what I call harvesting the building, harvesting money off of your property through cash out refis. And that's something I'm doing now at the age of 39 while I'm relatively young. Once I get up into my 60s, I'll probably start transferring all this into the DSTs because that's when I want the cash flow. And let me be clear, there is a time to get cash flow. And there is a time when I'm going to invest for cash flow. And that's when I'm old. That's when I'm old and retired and I need to replace my income. Let's get cash flow. But when I'm in my 30s, I don't want cash flow. I want capital growth, appreciation, tax-free. So that when I'm in my 60s, I have a lot more to put into these cash flow assets. And any questions popping up on chat, feel free just to chime in on them. What I'm going to go through now.
I did send you a couple, if you want to look at your
My
phone.
chat?
No, your phone, your actual cell phone. I sent you a couple of questions.
Copy that. We got some questions on cell phone. This is new. So the questions are, let me read them out so everyone can hear. Please address the exit strategy as in purchasing the last property is the one you plan to retire in. Well, I'm not going to retire in any of these because I'm not going to live in them. I'm just going to live in the house I'm in. That would be my plan. But if you're talking about the exit strategy of all these 1031 exchanges, well, it's one of two exit strategies. Number one, you just keep this fiveplex and then you die and you leave a $2.5 million asset to your children and they sell it for $2.5 million and now they got $2.5 million in the bank. It's a better way to get millions of dollars than playing the lottery. I can guarantee you that. So that's one exit strategy. And by this point, you might not need the cash flow. I mean, you probably got enough cash flow just coming off this $2.5 million asset that you're living a happy life. But the other exit strategy that I see a lot of my older clients do is the one I just mentioned. They'll sell the $2.5 million and roll it into that Delaware Statutory Trust, the DST. And folks, the DST is a 1031 exchange. You can roll money from an actual physical building that you own by yourself into a $100 million building that you own with 100 other people. That's still a 1031 exchange, and that is why the DST is so popular amongst older people that are now just looking for cash flow.
And really quick, Patrick.
Yeah.
And really quick. So, and I'm curious about this. Can you take multiple assets and like depreciate losses as an entirety on your properties, combining them into like say an LLC, or the same way that you would, you know, kind of like mitigate some losses, you know, when you take your properties and put them together?
Can you take multiple properties?
Yeah, and create a business entity through the profits of those properties. So that way, when you take losses from some and others, you're able to, you know, to just incorporate the business, the actual business on it.
That's getting tricky. Now, if you're gonna take a property that you own and transfer it into a business entity, like an LLC that multiple people own, bad juju. You just triggered a transfer and you've got some tax consequences now. Before you do something crazy like that, definitely talk to a CPA. Now, if I take a building,
I have a couple of people that have even sold off their VA loan to an LLC to reuse their VA loan. So, but they created their own LLC and sold the building to themselves. So I'm just interested in
now that's different. Now that's different. You have two different types of LLCs. You can have an LLC, Vanessa. If you and I have an LLC together, multiple member LLCs, that is not a pass-through entity. If I have an LLC that only I am on, or an LLC that only I and my wife are on, that's the same as just having it in my name. That's the same as just having it in my trust. It's now a pass-through entity. I've moved all of my properties. I had them all in my name, and I moved them all into LLC. First move, then I moved them all into my family trust. not a tax consequence, because these are all pass-through entities. And we can
Say
talk
that one
about.
more time, because I don't know if it was my internet or yours, but like the last few words that that you said were that you transferred them all into your LLC, and then what?
And then I realized that's not the best place to hold my real estate. And we can do a whole topic on LLCs versus trust versus in your name.
Yeah, we'll do another thing, but what was the progression of where you moved your assets?
So from my name into an LLC, and then out of the LLC into my trust. And now I just hold everything in a trust. I wouldn't hold my real estate in an LLC. There's reasons to do it, but there's more reasons not to. And we can talk about that next week if you want. Actually, that's a good topic for next week.
Yeah, absolutely.
LLC or not.
And we did get a few questions on DSTs that you can look at on the question and answers. We're kind of blowing up on the questions. So, but, so go ahead and glance at those and see what the best way to
Yeah, and we got another question here. When you refinance a property you've owned for 10 plus years, are you concerned about the loan term going back to 30 years and how little of the payment goes to principal early in the mortgage? No, I'm not concerned about that. In fact, I look forward to it. I don't really care how much principal goes to my mortgage payment because, and I just told you a story about how I got $2,000 going towards principal, and that was really cool. You know what I would prefer even more? If that was an interest-only loan and I had $0 going towards principal and that $2,000 was just going into my pocket. If I could get a mortgage that's longer than 30 years, I would. On one of my properties, I have a 40-year mortgage. My goal in real estate is not to pay down the mortgage. If my goal in real estate was to pay down the mortgage, I would be making extra payments every month. My goal in real estate is to watch that appreciation grow and watch it grow tax-free. Because let me be clear about something. A lot of people don't realize this. Your principal portion of your mortgage payment on an investment is taxed as cash flow. That $2,000 that I'm paying in principal every single month, the Uncle Sam looks at that just as if it were going into my pocket. Uncle Sam, the tax man, does not differentiate between cash flow going in your pocket versus cash flow going to pay down your principal. So I would rather pay down that principal as slowly as possible. Tiffany, you're the one who asked that question. No, resetting that 30-year period does not bother me. In fact, I look forward to resetting that 30-year period. I prefer not to have anything paid off free and clear because I know that my real estate investments are going to make me 5, 6, 7% return. And I know I can borrow money at 3, 4%, less than the return. So I would rather not pay off that mortgage. Again, paying off a mortgage is depression era thinking. Keeping a mortgage as long as possible and prolonging it is multimillionaire thinking. Okay, you want to have that cheap debt. And as far as other questions, I'll take a look up here in the chats to see what else we have. Isn't there also a strategy occupying the property to the last 5 years and still tax-free as well? Absolutely. So what I've been talking about with 1031 exchanges, you will never, ever, ever, ever do a 1031 exchange on owner-occupied property. Why? Because you can't. You can only do a 1031 exchange on investment property that you don't occupy. Now, let's shift over to owner-occupied property. If you've owned something and you've lived in it for 2 of the last 5 years, you can now sell it tax-free. Now, tax-free if you're a single person, up to $250,000 in a gain. So if I'm single, and I bought a $500,000 property, and I sell that property for $750K, I get $250K tax-free. If you're married, you can make up to $500,000 tax-free, as long as you lived in it 2 of the last 5 years before sale. What does that mean, 2 of the last 5 years? It doesn't have to be the last 2 years. You could have lived in it for 2 years and then moved out and not lived in it for 3. Did you live in it for 2 of the last 5 years? Yes. You could have lived in it for 1 year, moved out for 3 years, and then lived in it that last year. Did you live in it for 2 of the last 5 years? Yes. You can live in it for 1.5 years, not live in it for a couple of years, then live in it for 6 months. If the total months you've lived in it equal 2 of the last 5 years, you can now sell it. And as a married person, make $500K tax-free. As a single person, make $250K tax-free. Hopefully that answers that question there on owner-occupied. What if I got an investment? I got an investment condo downtown. I haven't lived in that in a decade. But if I move out of this house and I go move in that condo for 2 years, now I don't have to do a 1031. I just lived in it 2 out of the last 5 years. So if you want to sell an investment property, you can move into that investment property and live in it for 2 years and then sell it and make all those gains tax-free. Another question here. Can a DST go bankrupt? Everything on earth can go bankrupt. Everything can go bankrupt. A person can go bankrupt. A business can go bankrupt. So yes, everything can go bankrupt. So you want to make sure you are investing in a vetted and a well-established DST company. And if so, where would my place be in the line of creditors? Well, when any time a building goes bankrupt, in real estate we call that foreclosure. So can a DST, can a building and a DST go foreclose? And each building is sheltered from all the other buildings. One DST is the one building. It's not like your investment on this one building is connected to a lot of other investments that you have no skin in the game on. You are sheltered in that one investment. But if that one investment goes upside down, the first people get paid off is debt. The second people to get paid off is the equity, and you would be the equity portion. But again, that's why you want to make sure you're investing in a good asset. It doesn't matter if you're investing by yourself, with your buddy, or if you're investing in a DST. Make sure you know the financials. Next week, someone wants us to talk LLCs. Yes, we'll talk those. Can 2 out of 5 years work if a property still has a mortgage on it? Absolutely. You can own it free and clear, or you can have a mortgage on it. As long as you've lived in it 2 out of the last 5 years, you can make that $500,000 tax-free when you sell it. Can you let your kids live in the property for 2 out of the last years instead of yourself? Short answer is, I don't know, but I would say probably not. I don't think that's going to work unless your kids are on the title of the property. Do your kids own the property? If your kids own the property, then probably. If you own the property, then probably not, because you haven't lived in it 2 out of the last 5 years. But for that question, because I don't know the exact answer, I would say talk to a CPA. And then last year we got an equity investor and a DST. Would I have a say in who manages the building, the rents, etc.? Not at all. When you invest in a DST, you are investing, consider it like a stock, like a fund. You're giving your money to a management firm that is going to manage the asset for you. They're going to manage the rents. They're going to manage the repairs. You are 100% hands off. People invest in DSTs for 2 reasons. One, they want to do a 1031 exchange and they don't want to put it into a building on their own. They want to put it into a building that a lot of other people own, and they just want to get checks in the mail because they're 65 and they're retired. So they want to do that 1031 and not get taxed, and they don't want to have to manage a property. If you want to manage a property, if you want to actively manage a property, then don't invest in a DST. Again, that's why really the main people investing in DSTs are folks that made a lot of money through appreciation. They want to do a 1031 and they don't want to actively manage what they put that money into. Is there a strategy for occupying the property 2 of the last 5 years and sell tax-free? Yeah, the strategy is pretty basic. Occupy it 2 out of the last 5 years. And again, I can't get more clear than that. If you've occupied it out of the 2 out of the last 5 years, period. There's no gotchas, there's no gimmicks, there's nothing funny. 2 out of the last 5 years. It doesn't have to be 2 years in a row. Let's just say 24 months out of the last 5 years. So yeah, I got investment properties. If I sell my house someday, I'll probably move into my one of my investment properties, and I'll live in my investment property for 2 years, and then I'll sell it, and then I'll make that money tax-free. Another person asks, is a DST similar to a REIT? Similar, but not the same. A DST invests in one building, one asset. And you usually got to have a significant amount of money that you're putting into it. And you can 1031 into a DST, i.e. sell a property, not pay taxes, and put it into a DST. With a REIT isn't necessarily going to have just one building in it. A REIT is a real estate investment trust. A REIT is kind of like a mutual fund. It's a real estate investment fund that owns a lot of property typically in its portfolio. You also don't have to 1031 into it. In fact, you're not going to 1031 into a REIT. You could just write a check for $5,000, $1,000, $100, and just give them some money. But you're not going to be 1031ing into REIT. So similar in that they both own real estate, but definitely not the same. Are you investment property a rental property? If so, do you have it under LLC? No, I don't have anything under an LLC. I hold it in my trust, and I'll go into the reasons why in next week. Next week, we'll talk about trust versus LLC versus owning it yourself. There's some reasons to have it in an LLC. And again, I always got to give this disclosure. I'm not a CPA or an attorney, so I can't give tax or legal advice. But what I can do is I can tell you what I do. And if you do what I do, that's up to you. And if you go bankrupt doing what I do, that's also up to you. So, take what I say and then do further research. But there's reasons to have an LLC in California, typically reasons not to. And I can tell you that some of my highest net worth investors own their property in a trust, not an LLC. Yeah.
Awesome.
We're towards the end of time, aren't we, Vanessa?
Yeah. We don't have a hard follow on, but we can wrap up whatever we're talking about, and whether it's questions or your presentation. And
there's one question.
All of the members, yeah.
One question here I definitely want to answer. Someone's asking, Susan asked, can you do a 1031 exchange with a property you acquire through an estate you inherit but want to sell for investment property? Susan, and for everyone else out there, if you inherited property, you should not do a 1031 exchange. No, don't do a 1031. If you inherit property, remember guys, look at this, tax-free. If you inherit, in this example, a $2.5 million property, you can sell it for $2.5 million. You don't have to pay taxes. Even if your father, your uncle, your grandfather bought it for $500K and it's now worth 2.5, you don't have to pay taxes because you get a step-up cost basis. If you inherit property,
in your will
get a
for
good
your
CPA.
children, in your will for your children, you leave them the assets, you instruct them to sell it, and then now they get to take that money, that tax-free money opportunity that they only get to capitalize at your death, and they reinvest that money.
Yeah, but don't do a 1031. Sell it, take the hundreds of thousands, take the millions. It's all tax-free because it's inherited. It gets a step-up cost basis. And if you got an inheritance, you definitely need to get with a really good CPA. And yeah, my Thursday webinar, guys, I'll see if I can push that out to all of you if you want to tune in tomorrow. I'll get that posted on LabCoat's Facebook page, and I'll put the link up for that.
Yeah, and we'll and what they can do too is they can email you too, so that you can send them, if they email, or maybe your assistant, if you want to, just think, we'll definitely look at broadcasting it here. And also if there's specific people, so email Patrick and he can forward that to somebody that will be able to send you a link to join the webinar. And Patrick, that's tonight at what time?
Just put that in. It's tonight at 5:30 p.m. Pacific. And what I do, it's 90 minutes, and I give a real estate and economic update. It's going to be heavily focused on San Diego for obvious reasons. It's where I live. But I'll talk a little bit about the broader market. If anything, I'll give you an idea of what you should be talking about within your own market.
Yeah, just so that we can see the format. And, because essentially becoming the reason why you invest your time, aside from your own benefit about learning these wealth building strategies, but it's to learn how to lead generate with this, right? This is how you add value to people's life, and then you organically lead generate based on your, you commanding yourself as an industry expert. So
I just posted the link too. So there, register on that link. If you click on that link, it'll take you to register this evening. Again, it's at 5:30 Pacific, and all you got to do is click the link. Someone's asking for my email. Yeah, and guys,
he posted his email. Email, so it's patrick.kappel@Compass. Is it Compass Realty?
No, just patrick.kappel@compass.com. Yeah,
Okay.
pretty easy. But if you just click on that link that I posted in the chat, you'll be able to register for tonight's 90-minute meeting. And yeah, it's a lot of fun. I mean, this, guys, what you'll see me do tonight is how I built my business. It's how I get all my clients, just by doing webinars and getting new clients and old clients and past clients and providing value to them. So definitely click on that link. And I don't do any cold call. Guys, I've been in this for years. I haven't made a cold call ever since I left commercial and went to residential. And my team will do about 80 million in sales this year. None of us do cold calls. That's a 1970s way to sell real estate. The way to get client, it is. Like, who uses
the
a
way
phone
you get
these
clients
days?
is you build rapport by adding value and knowing your shit. Excuse my language.
Yeah. Yeah.
But
yeah, nice.
so for those that are sending their email, okay, so this is the instructions. It's not on Facebook. Ready? If you want to join Patrick's webinar, he did post a link in the chat. You're gonna have to scroll up and find it. If you don't find it, email him, and it is patrick.kappel@compass.com. So email him, and then he'll be able to take your email from your email. You know, don't post it right now. We're not making a list, but email him, and he'll be able to shoot you the link, because that way it's a quick way for him to send you the link to register, or he can have an assistant make a list for you guys. Okay. Yeah. So, yeah. So I guess last question, we'll just say, and I already know the answer. You've addressed this before. Why did you leave commercial real estate? And then we're going to end with that.
Yeah, I left commercial, you know, multiple reasons. One is it's a very sharky type of environment. It's ethical, but not the most ethical. Everyone's just in it for the money. And I wanted to do something really just to help people and work with people that are a lot like myself. I always like to say, when I was in commercial, my job was to make millionaires multimillionaires. And my job now in residential is to make average people millionaires. And I really like working with average people like me, like especially a lot of military vets. And
just taking people from nothing to something, to help them like change just raise their lid, change their financial position, you know. And I think I talked about this in last week, is that when you help, you know, when you teach people these mind shifting opportunities, and you take people from just surviving to thriving, you're able to give them the opportunity to be in a posture of giving and a posture of generosity. At the end of the day, that's the reason why we even accumulate any of this stuff to begin with, is just to be able to give it away, to push it forward, to bless others. And that's the opportunity.
And I think I just pushed out the link. If you guys can see it now, please let me know. I realized I was sending it to all panelists. So I think it was just like going to me and Vanessa. And then I switched it to all panelists and all attendees. Oh, good. You can all see it. So there's the link. Click on that. You can register for tonight. And I also sent you an email if you need to get the link that way. But yeah, the other reason I left commercial as well is...
Left commercial.
Yeah, left commercial is... In commercial, you really need to understand real estate. Like the commercial firm I was working at, you can't even get an interview unless you got a 4-year college degree. Part of the interview was, did you play an NCAA sport? If you didn't play an NCAA sport, you had to get a waiver, because they want people that are hyper competitive. And that's commercial brokerage for you. Hyper competitive, lots of like sports athletes that don't know how to lose. You only win. And there's no such thing as falling down, because you just get back up. So hyper competitive, hyper intelligent people, everyone knows what they're doing. And I thought, if I have like the competitive nature of a commercial guy, and I've got the knowledge of commercial real estate, but I go use it in residential, what's going to happen? And I went and used it in residential, and within 12 months, I became a top 1% agent in San Diego. Because no offense against residential agents, you guys are all smart and you're hyper competitive because you're spending Thursday morning on this. But you all know there's a lot of agents out there. Small percentage on LabCoats. There's a lot of agents out there that are maybe not the smartest kid on the block and are not that competitive. So if you're hyper competitive and you're knowledgeable, you can really kill it in this industry, in the residential side.
Yeah, you want to be the one that's able to offer the most amount of insight in your industry. And so, yeah.
Yeah.
Alrighty. I'm getting ready to go to SD.
Yeah, there's smoke. There's smoke in the air. Everyone's wearing a mask anyway, though. So
yeah, so just wear the mask. All right, guys. You guys have an amazing day. So nice to see you. We'll see you next week. And keep your emails out for your emails on the paid 2-hour tax course that Patrick is going to do.
All right.
Kiddo.
Sounds good, guys. We'll talk later. We'll see you next week talking LLCs. Bye.
Bye.